Worried the AI boom has run its course? Well, there are other investment trends where you could have made almost as much money in the last year. And while past performance is no indicator of future returns, prices of a number of commodities have soared, along with the shares in the companies that produce them. From decarbonisation to defence, and yes, the energy needed to fuel the AI boom, industry is retooling. What does it mean for investors? This is Fidelity Answers. Hello, I'm Seb Morton-Clark, and this is the series where we tackle the questions investors are asking of the people managing their money. This month, given the rotation we're seeing in markets, is there a new investment case for commodities and industrials? To mine the facts, I'm joined today by a top selection of Fidelity's investment brain trust. Ashish Bhardwaj is a portfolio manager in the equities team, running strategies which focus on industrial companies all over the world. Next to him is portfolio manager Oliver Hextall. He specializes in the metals and other materials that Ashish's companies use, as well as the miners and refiners who deliver them, all fueling and fueled by the energy transition. And for some extra research heft in the studio today, I'm very pleased to say that we have EM commodities analyst Laura Stafford, who watches the companies that have made the most of that price surge. Welcome to you all.
Thank you.
Thanks.
Laura, let's start at ground level, shall we? What sort of price gains have we seen in commodity markets over the last year, and why has that been?
Oh, some pretty big moves. So you're looking at kind of a gold price has gone up by, from 2000, mid 2000s to, close to 5,000 now. Copper's gone up by $2,000 odd a ton. And those kind of gains have been also followed in the lesser known precious metals, so silver, which has more than doubled, PGM prices, which have moved considerably as well.
PGMs?
Platinum group metals, so platinum, palladium, rhodium. There have been a lot of different factors driving that. So for copper, there's obviously an element of bullishness on the long-term outlook. There's also serious market dislocations on the back of kind of tariffs and potential tariffs being implemented by the US administration. And obviously, in some cases, there's a bit of FOMO as everyone watched the gold price move. Some of the precious metals that are more industrial by nature have kind of followed suit.
So is it fair to say we're moving into a more asset-heavy investment phase, Laura? Because we've heard lots about AI, software, platforms. Is this the next step?
I think there's an element of that. There have been a lot of different drivers, right? So for the gold price, you can see that there's been a clear push by central banks and then other investors looking to kind of diversify away from the US dollar effectively. And we would think that those trends are sustainable. For copper, there's obviously a long-term demand outlook that is very positive, be it for AI data centers, for building out the grid, etc. All of those things will need copper supply. And that is meeting an industry that has actually probably been undercapitalized over the last kind of decade. Materials, commodities are very sexy now, but they weren't a couple of years ago. And in a lower price environment, a lot of these companies have withheld investment where they can to try and stay afloat. So you're now seeing the repercussions of that with supply that isn't necessarily able to meet demand now, or certainly won't be able to in the future.
Interesting. Okay, I want to come to Ollie on this point then, because obviously this is driving a lot of interest in the companies operating in these areas. But for first off, just a little bit of history, because this comes after a bit of a rough patch for the industry, it's fair to say.
Yes, that's right. I mean, I think the industry's had a pretty long rough patch, actually, really, if you think about it. I mean, when I was an analyst covering the sector in 2014, 2016, the sector nearly halved, probably went down even more than that.
Right.
It was very, very tough. And obviously, this is all coming off the back of the China-driven super cycle, which was extremely powerful. It drove all of these commodities up very strongly and the companies that produce them. Since that point, obviously, there's been fluctuations, there's been big moves, but there hasn't really been the same structural drivers that we saw during that period. Arguably until kind of where we are today, I would say. I think even looking back a year and a half ago, it was still pretty tricky for a lot of the commodities that we're focused on. Even where you're seeing kind of expectations of supply deficits coming in, they weren't coming in immediately, they weren't coming in until a few years' time. Demand was disappointing. China, whether you like it or not, you can't get away from it in this sector. It's still more than half the demand for most of the commodities that we look at. And obviously demand trends there have been weaker than expected. So there's been a huge amount of issues and things that have made it quite tough as mining investors. So we like our moment in the sun, which hopefully is now.
And what's changed then? Why is there a moment in the sun?
Well, I think actually what we've seen within the strategy I work on particularly is over the past year or so, several different factors have come together. So, for example, we're very focused on decarbonisation. That's the key driver of the kind of commodities that we're looking at in the strategy that I work on. But over the past year or so, as Laura mentioned, all of these other factors have come together. So you've seen kind of continuing fears around de-dollarization. You've seen demand strength on the AI boom. You've seen some of the political decisions in the US administration really change the dynamics around tariffs, which have meant that copper's been hoarded in the US. You've seen much more of a focus on geopolitical risks and tensions again on the back of that. As part of that, you've seen critical mineral supply chains become much more in focus, where suddenly we've realized in the West that we're extremely dependent on a few different regions for some commodities we can't live without. So I think that's really what we've seen is this huge coalescence of all these different themes coming together. And that's put huge pressure on industries and metals that haven't really been invested in for a few years. Suddenly there's a scarcity, and that's when you see these big spikes in prices.
So is it fair to say that there's a mismatch at the moment between the demand in the market for some of these stocks and the supply of these investable stocks?
Yeah, absolutely. I mean, I think you have to kind of go commodity by commodity. Some of them are more macro driven, like Laura's talked about gold and silver. But I think if you think about something like copper, what's been very exciting recently is that we've always had this deficit forecast in a few years' time. And then it's always been a few years' time as you move forward in the next couple of years as well. But now I think we're getting to a point where demand has been relatively resilient, fueled by things like the AI boom, data centers, people are very excited. Supply, though, has actually been very disappointing. So in the last 12 months or so, you've seen several very large mines either have to stop production temporarily, but stop production completely, or miss production guidance. And so you've created this mismatch in copper in particular between demand and supply. And that's when you do get these big spikes in prices. So yes, I think that's true. As you look forward for many different commodities, actually, we're getting closer and closer to the point where there is a real deficit and a real scarcity. And that's kind of what's getting people excited.
Okay, well, rising commodity prices, Ashish, presumably means rising costs for the companies that you cover. Are you seeing that show up in valuations?
Yeah, so they're both positive and negative impacts. So negative impacts come from your raw material prices go up and you need to have pricing power to maintain your margin. Now, most of the big, large industrial companies, they do have pricing power. But remember, they have already taken a lot of price increases during COVID and all those things. So there's a limit to how much price increase you can take. So my belief is that, if commodity prices, they keep going up, there will be a point where they will have problem actually. Right now, they're okay.
Mm-hmm.
On the other side, on the positive side, you can sell more equipment to these mining companies because these mining companies will have to debottleneck, look for new mines and so on. So there's a demand driver. So depending upon how you are positioned, if you're positioned in the right end market, well, it's good for you. But if you are not benefiting from those trends and you are getting hurt from the rising raw material prices, then you have a problem.
We are seeing some industrial companies start to thrift and try to substitute some materials out. So silver, for example, which we've seen move up nearly 3 times this year, starts to become a real problem. And so you've seen some solar manufacturers in China start trying to shift away to copper. It does take a lot of time, doesn't happen immediately, but I think that just shows that some of these companies are really feeling the stress from the price moves.
So are there companies, Ashish, that you're looking at where the cost of materials is changing investment or business decisions?
Yeah, if you think about air conditioning equipment, they use a lot of copper. I mean, right now they can handle it, but if it keeps going up, they'll have to figure out how to make their equipment more copper efficient or find some kind of substitute and so on. We are not there yet, but if it goes on like this, we'll be there soon.
So I suppose, Ollie, one of the obvious questions to ask is how much further does this all have to run?
I mean, that is the big question. I think, again, you'd have to break it down commodity by commodity, but I think obviously for commodities that haven't really moved up much so far, then it's kind of easier. We see clear upside. I think for the ones that are in focus at the moment, so precious metals or copper, I think it's a little bit more nuanced. And the way that we think about it is take precious metals. You can look at the prices today. We're trying to find companies that can really outperform market at current prices or even prices that are lower. Because if you run spot copper gold prices through the stocks, you do get quite different valuations still. So we think there's an opportunity in companies that are still undervalued on current prices. You don't need prices to move much higher to still see value. Equally, there are other drivers of upside, we would say. So we're looking for companies that can deliver better growth than expected in their assets, or maybe there's exploration upside and things like that. So I think for some of these commodities that have run very hard, you have to be a little bit more careful, even though we're still pretty bullish on a medium to long-term view, particularly for a commodity like copper, where we just see massive deficits coming through over the years to come.
So copper, any other commodities that you're particularly bullish on?
I think right now we're pretty bullish still on uranium as a commodity. We think actually that hasn't run as hard as some of the other commodities, despite also having pretty attractive supply-demand dynamics. And we think at some point you'll see a big catch-up there. You have to be a believer in nuclear, but we think that is a key driver of kind of green baseload power. So that's another one that we'd be interested in at the moment.
Are there niches in the sector where the boom hasn't yet been priced in?
On the strategy I work on, it's quite broad. So I think if you go outside metals, there are actually quite a few commodities which are at very different points in their cycle to some others. So if you think about pulp, for example, which we are interested in, that's actually pretty trough, we would say. It's been through a very, very difficult period. Laura's the analyst, so she knows even better than we do. But that's been pretty tricky. So we think there's an opportunity there, particularly if some of the supply side reform that we're seeing in Indonesia does actually kick in. Agricultural commodities, again, have been weaker. So I think there's opportunities there. So we think there's opportunities everywhere. But one of the nice things about the industry is that there's always different commodities at different points in the cycle, so you can kind of reallocate
pick
around
and choose.
them. Yeah,
very nice. Now, Laura, you've actually recently come back from an industry event in South Africa, mixing with I'm trying to think what's the collective noun for miners, but maybe just a crew will do.
Sounds right.
What was the vibe?
So because it's South Africa based, it was primarily kind of precious metals, a few copper produced, a few coal. There's definitely a sense overall that pricing levels have moved sustainably higher. So I think there was an element of disbelief at where we are with some prices, but there is a clear view is that we're not going back to the previous level. So mid-cycle has moved higher. They're all pretty confident on that. Smaller producers are definitely looking to gain scale very quickly, and you'll probably see more M&A in those areas. The larger producers, I think, which is quite interesting, capital allocation's holding. So in the mining industry, the boom happens, and historically they've spent loads of money on terrible projects, wasted a lot of money and burnt value. This time round, I get a sense of quite strict capital discipline. There's also a clear focus on shareholder returns, which is quite positive. So in that sense, it was positive. It's nice to see them positive, allocating capital to the right sort of thing, short payback projects, but with a focus on kind of returning value to shareholders as well. So in that sense, very good.
Very good. Okay. Now, Ollie mentioned that there are companies that are still worth buying even without another commodity spike. Do you agree? Is there some nuance there between which companies?
There are discrepancies between commodities. So, for example, in the copper space, that is a commodity that pretty much everyone is bullish on long term, and rightly so. And if you've got a company that is a pure play copper producer with good assets, the valuations have run very, very hard. And it is very difficult to see a value case there. Whereas there are some producers that are maybe smaller or have different commodity mixes, or for idiosyncratic reasons, say they had an operational issue that shouldn't structurally change the value of the business, but have seen the equities underperform. I think those are areas where you can get really interesting value opportunities still.
So that's the pricing dynamics. But should we talk about drivers? Because on the one hand, we have energy demand, which we know is rising, and then on the other is the energy mix, which is broadening. Ashish, perhaps you could tell us a bit about how things have changed on the demand side.
So the biggest change in demand is for electricity. If you look at the demand for electricity in the US, let's just focus on the US, it was like flattish for last 15 years. And what we are seeing, roughly 2.5% per year growth.
So flat for how many years?
About 15 years.
15 years.
Yeah.
2.5%. That sounds like quite a small number, though. Can you put that into perspective?
That's what, when people look at growth companies, like software companies, they go like 20%, 25%. So they would say, what is 2.5%? It's nothing, but it's a lot. In fiscal thing, if you want to grow at 2.5%, it is not easy. And that's what we are seeing in the US right now. So people are fighting to get electricity. So electricity is the big change. And, when Laura was talking about capital discipline holding up in copper and all these things, we are not seeing that in electricity. So to not have capital discipline, you need real bullishness on demand, and people are very bullish on electricity demand. And we are seeing a lot of capacity addition. It's not so easy to add. It will take time. So people are doing shortcut measures right now. The smaller turbines, near a data center, you can put 30 small turbines rather than waiting for a big turbine, which will come in 4 years' time. So we have seen huge demand growth in electricity. We have seen supply response. Right now, we are relying on smaller turbines and so on. Old nuclear power plants which were shut down, they are being restarted. So that's the plan. Right now, you rely on these things. In the medium term, you can use bigger gas turbine, like 1 gigawatt, 2 gigawatt turbine, which cost more, but they take more time to come up actually. And then you will have nuclear and renewable, everything. So all kinds of energy sources will be invested in.
What's driving this demand? Why is there such a sudden spike in electricity demand?
Biggest is data center, AI. So out of 2.5%, roughly half of that is coming from AI related demand. Other is coming from various other sources. Like, if you want to electrify your transport network, that requires electricity. You want to reshore, you want to have more factories in the US, that brings demand back. So there are other demands, but half of it is coming all from data center alone.
So a big infrastructure build out that needs to happen here. And I guess this is where your industrials companies come in.
There is shortage of electricity, especially shortage of electricity at peak demand. That's the concern. And that's where people are building capacity, and a lot of industrial companies are getting benefited from that. We are already seeing that. It's going on for roughly last 2 years right now. Things have run up a lot. My feeling is that this drive to build AI infrastructure, we are in the middle of it. It will go on. But going forward, the real opportunity to make money is somewhere else, not here.
This is interesting because I know that you make a distinction, don't you, between the AI enablers, so the chip makers, hyperscalers, those who are building the infrastructure that's going to help support the AI revolution, and the AI adopters, so the companies that are going to be using AI to improve efficiency, logistics, innovation, etc. Can you share some of these examples?
Yeah. So think about AI enablers. AI enablers could be either semiconductor companies or electrification companies and so on. Everyone knows the story. These stocks have been outperformed for last 2 years. Valuation has run up a lot. But you have put in so much money in AI. Now it is time to use that AI. Till now, what we are saying, AI is mainly being used in companies like Google, Meta to make their advertising more effective. But it is going to broaden. And we are already seeing examples. Companies which run complex logistic network, they are using AI to match better the demand and the supply of transport facilities. We have seen very interesting use cases. We came across a paint company, and the challenge in paint is that you want to make paint which dries quickly but has good quality.
Mm-hmm.
And how do you make paint? You combine different kind of chemicals and you come up with paint. And scientists work on it, they try, they experiment. Now, this time they used AI. AI came up with a combination which their scientists never thought about. And they experimented with that, and it was quite good. So the paint dries, quality of the paint is good, and it's in the market. The product is in the market.
Wow, so we're all painting now our houses with AI paint.
It's not for house, it's probably for car right now, for refinishing and so on. But it's already in the market. So a lot of companies, my belief is that will be able to accelerate innovation, come up with new product and so on. So from here onwards, our goal should be to find companies which are able to capitalize on investments which have been made into AI to either become efficient or they will be able to innovate faster. And that's where we will see gains of AI happening.
Very exciting. Ollie, all this activity requires raw materials, obviously. And this is one of your central arguments to your investment thesis when it comes to transition materials. Has this all been priced in now?
Well, no. I mean, I would say that it hasn't so far. I mean, I think one of the beauties about commodity markets is ultimately they are spot markets often. So until the demand actually hits and the supply isn't there, or if it's not there, then you see the price really fly up. So I don't think it's been priced in personally. I think, again, you have to go commodity by commodity. But what people are getting excited about is that you can see these deficits, as I've talked about already, a few years into the future. Suddenly now, as all of this demand really does kick in, you can start to believe in those deficits. And then we would say there's still plenty more to go for.
Just one thing to add on copper. It's a very good commodity because demand is good. Your existing mines, your grade keeps going down. And adding new capacity is very hard.
And takes a very long time.
That's the thing, isn't it? The cycles here
Yeah.
are extreme.
So you're always behind in adding capacity because your existing mines keep having problem, and new mines is not so easy to add.
And the other beauty of copper is that China doesn't control it, so China can't destroy it as it has done with many other commodities.
It's a safe bet in that sense.
Yeah.
Laura, how would you cast this? Is this a problem fundamentally around supplying what everybody needs?
I agree exactly with what Ashish was saying. So for something like a copper project, you're looking at a 10-year plus investment cycle to bring on new capacity. And while the copper price looks very high now, it didn't 2 years ago. And what you've seen is the severe capex inflation, mean that the amount of money you need to invest to get that copper out of the ground 10 years from now is much higher than it was. And so for a company to invest, they need to have a pretty strong view that the price is going to be where they need it to be in 10 years. And until recently, you really haven't seen that. I mean, even now, I think what you've seen, in the copper space is you're looking at like the big players are buying projects. They're not looking to build them themselves. Everyone is trying to get the quick fix to bring supply on, because everyone's still reluctant to kind of invest the very heavy capital, because, from an equity point of view, even shareholders aren't necessarily going to reward you for sinking loads of money when you're not going to get a return from it 10 years down the line. So it can often be that misalignment between when you need to invest and and having a vision of where that pricing is going to be. But to kind of circle back to what Ollie was saying, in something like copper, you are now actually getting to that crunch point where people can see, oh no, there really isn't enough copper, and no one's sanctioned enough projects to meet that demand outlook in the next few years.
Taking all that into account, what's your view over the next few years then? What will the sector look like? Consolidation sounds like one aspect of that.
There's been a lot of kind of speculative money in the space, particularly around gold and silver and PGMs to a lesser extent, right? So I think people have looked at those moves and gone, oh, I don't know if that's underlying demand or not. In the case of silver, you could argue that perhaps it's not. But for the others, I think there will come a point where investors get comfortable that pricing has moved structurally higher, like the miners are already pretty confident they have. And then that will allow producers to start making longer term decisions about how they invest capital.
Ashish, what about regional differences? So you talked earlier about the US, but I wonder, how does sort of Europe, for example, compare to a country like the US, where you're looking at different dynamics there, regulatory dynamics, different demand perhaps dynamics? What plays are you looking at between regions?
Yeah, so there are 2-3 things we can think about. Like, when you look at Europe, so US has been very aggressive in terms of trying to insource as much as they can. I mean, there is limitation of how much they can do, right? Europe, we haven't seen that much move actually. And in Europe, there is a real crisis, especially when you think about energy. Energy prices have gone up so much that we are seeing deindustrialization. A lot of marginal chemical plants, refining plants have been closed. And if you want to have your domestic defense industry, you can't really, have everything else outsourced. You can't be just making tank and everything else coming from outside. So the difference, what we are saying, US has a much more advanced strategy. Whether that is effective or not, we can debate, in terms of being more self-dependent, while Europe hasn't shown its card. And what we should expect going forward, my expectation that Europe will move towards US. Like, so far the focus was all on decarbonization, everything. Going forward, the focus will be more on self-reliance, affordability, and reliability. So we will see more movement in Europe to make new projects cheaper, more viable, and we will see global partnership also. If you can't rely on unreliable suppliers, then you need to have partnership with like-minded countries. Partnering among countries to secure supply chain for AI-related things, actually. So that means everything which is involved in building data center, all the supply chain material, everything. So you can partner among like-minded countries. Europe will have to do the similar thing. In a way, Europe-India trade deal was something like that. But right now we have a problem in Europe.
Let's talk a bit more then about this energy mix and the energy transition, Ollie. As Ashish has mentioned, obviously decarbonisation has been questioned by US policy over the past year. What's the net effect of that?
So I think before the new administration in the US, people were very worried about what might happen once they came to power in terms of the decarbonisation agenda, because obviously a lot of the talk beforehand was very, very negative. I think since the administration has come into power, it's been a lot more nuanced than maybe people were thinking to start with. So, I mean, the first point I'd make is that just economically now, a lot of the renewable energy is very, very viable. And that's ultimately the biggest driver of people's investment decisions. I think still, if you look at 2025, the vast majority of new power capacity in the US is wind, solar and storage. So I think that's one key point. And the second thing is that even though there have been some negative parts of the administration's decisions around the renewable agenda, they're still quite supportive of other pieces. So nuclear, for example, they've been relatively supportive. If you look at biofuels, actually the renewable volume obligation hasn't been confirmed yet, but they've been quite supportive there, particularly because obviously that keeps US farmers on side. So I think bits of that have been better than people expected. But I think the big picture from a global transition perspective is that the US isn't actually that significant. It's sort of less than 10% of EVs or copper demand. The biggest driver of the transition is China. And they're pushing ahead really, really strongly still. If you look at the latest 5-year plan, they're still pretty aggressive on all of these areas. And so, for us, again, focused on commodities, we don't really mind if they're being bought by the US or China, they're all commodities. So I think the net effect in the US has probably been a lot more nuanced, probably better than people expected. But at a global level, it doesn't really change things that much.
When we think about materials security, I mean, it's a multifaceted, complex challenge. Could you just sort of walk me through what are the main problems that these countries face in order to try and assure themselves a decent supply of these materials that are just becoming so important?
I think that's been a big change over the past year, is people really waking up to the fact that some of these materials we've sort of taken for granted and are absolutely essential to major parts of the economy and very sort of important pieces of the economy, like defense, for example. We're entirely reliant on other parts of the world where we have no control over the supply chain, particularly China. Most obvious example of that is in rare earths, where over 90% of production is from China currently. This is absolutely essential in EVs, wind turbines, magnets, defense, and we've seen real support for any domestic producers of rare earths. There was a big deal with MP Materials where the government's actually guaranteed a floor price for their product, effectively ensuring that they can make money throughout the cycle. And so, that's been a major step. I think we'll see something similar in kind of uranium and the nuclear supply chain. It's become, I guess, partly as a result of some of the geopolitical issues that we've seen, but it has become a major focus. And I think that the West will follow suit, Europe as well, I think, at some point.
How do companies that are going to decide to make the jump and invest in that sort of in a refiner, for example, how can they be sure that they're going to get the volume through?
I think the issue has been that China has had a lot of foresight in a lot of these areas and has decided from a very early stage to invest really heavily in some of these critical areas. And it's not just the raw materials, as you say, it's also the processing. So often, even if the raw materials are outside of China, outside of their access, everything has to be sent back into China for processing. So they've invested behind those industries. They haven't worried so much about returns or profitability in the short run, but they've put themselves in an extremely dominant position. And it's then very hard as a Western producer to compete, because your customers ultimately can pay a Chinese price for something, and it's a lot cheaper and a lot more effective. So the question now is, can we have a sort of decommoditized commodity land where you have Western customers willing to pay a premium for Western supply, maybe? Or do you have to see governments come in and stepping in and subsidizing that Western production, so then you're not disadvantaging your customers? But yeah, I think that's exactly the issue, and that's what governments are looking to address now.
That's what is happening in the US, like Defense Department giving purchase guarantees, minimum price support, and even it's not like the facilities are not there in Europe. There are facilities to refine these kind of things. You just need some kind of government support to do that.
Laura, is that what you expect then? Is government support in order to sort of provide a security blanket, as it were, on those companies that are looking to take part in that investment?
I suspect you will have to see that. I mean, as Ollie said, that the US is on the front foot, and in a Western context it is, but versus China, we're very much on the back foot. They've been doing this for over a decade. I cover a platinum group metals producer, and they produce palladium, and you can't get that really outside of Russia or South African. South African supply is on a gradual decline. This producer has been lobbying very hard to get to tariff Russian material because, as they say, it's on your critical minerals list. It's not economic really for us here. If you want to sustain this, you need to provide tariff support or some kind, and they're already getting tariffs. They're already getting tax credits on their production. But I think you'll have to see more of those sorts of measures if you do actually want to cultivate your own supply chain that is secure.
Okay, and then beyond commodities, Ashish, what other investment ideas are you looking at in response to everything that's been spoken about today?
Yeah, there are three key things. One we touched earlier, like AI enablement to AI adoption. Second, if you are building so much new defense factories and this and that, you need to have more better investment in your industrial facilities because otherwise you can't really do that. So my sense is that defense investment will be a catalyst for industrial recapitalization of the West. And then the third thing, if you look into, which we talked about, energy. Till now, it was about moving decarbonization. But if you look at investment made in oil and gas, since 2015, it has gone down, while investment in renewable has doubled. If you look at all reasonable forecasts going forward for next 15 year, 20 year, oil and gas investment is not going down. It won't go up too much, probably low single digit, but it is not going down. Renewable will keep growing. Nuclear will be another growth area. Blended, what we need to see, investment in all kinds of energy sources. We have been going through a lot of unstable kind of flip-flop in energy policies that needs to change.
Well, thank you very much. It's time to start drawing things to a close, but we are going to, first of all, play hotcakes and hot potatoes. What are you buying like hotcakes and what are you dropping like hot potatoes? Ollie, I'm going to start with you. Your hot potatoes.
I work on a strategy. We're focused on commodities, and we're very bullish on commodities, driven by all of these trends we've talked about. So decarbonisation, AI demand, critical mineral supply chains, inflation, even those sorts of factors. But we think in the future-facing world, there'll be very clear winners and losers within commodities. So we think that you need to be invested in areas like copper or uranium, which are going to benefit from these trends. And we think you need to avoid areas like iron ore or thermal coal, which we think are sort of legacy backward-looking commodities, much more focused on the Chinese supercycle rather than what we see as demand drivers going forwards, despite the fact that those commodities make up the majority of a lot of the metals and mining indices that you see today. So I'm going to say my hot cake is the go forward transition commodities, and the hot potatoes are the legacy commodities like iron ore or thermal coal.
The dirty stuff.
The dirty stuff.
Okay.
Yeah.
Laura.
I still think there's a lot of value, even in commodity, even where commodities have run quite hard. I think there'll be idiosyncratic reasons where stocks have sold off or there's been a temporary operational issue and the stock has overcorrected. So I think my hot cake is value in gold or copper because I think you still can get those. I think you just have to work a little bit hard to find them. My hot potato is also in copper, but the investment frenzy has led to some really, really strong moves in some of the equities. And to be frank, some of them look quite overvalued here. So be it a great producer, but with a multiple that's beyond what it's traded at historically, pricing in a very aggressive copper price, or a terrible state producer that has run really hard, but is still a terrible operator with terrible assets. I think those are the areas where, particularly if I'm a little bit unsure in the short term, that is where I'd be looking to take money away, or I would call a hot potato.
Okay, it sounds very sensible. All right, and then Ashish, finally with you.
I feel quite good about US housing actually. So if you look at US housing, activities have been very depressed because mortgage rates have gone up, house prices have gone up, and they're not affordable. But we are reaching a crisis point. There is clear shortage of housing in the US, and people are not happy. And we have seen a lot of actions from the government. We will see more. And my belief is that activities will restart. And there are a lot of stocks which are very attractively valued along the whole chain. So US housing, I feel quite good. And in terms of hot potato, I think there are a lot of places where fundamentals are good. I don't dispute the fundamentals, but the stocks are pricing in way more than the fundamentals. European defense, I will give you an example, right? Yes, Europe will increase its defense spending, as I was just saying, and it will grow. But, you can go out 10 years and price all of those things, and then you can see stocks are pricing way more than that. So I would avoid those kind of stocks.
Okay, be cautious on defense. Very good.
European defense.
European defense specifically, sorry. Thank you, Ashish. Well, that is all we have time for. Thank you to our portfolio managers, Ashish Bhardwaj and Oliver Hextall, and to our analyst, Laura Stafford. You can find out more on the topics we've discussed today on your local Fidelity website or at fidelityinternational.com. If you've enjoyed today's episode, please like, share and subscribe. The producers today were Patrick Graham and Rachel Reed, with production support from Connor Bailey and Alex Wilcox. For now, from all of us at Fidelity, goodbye.